Welcome to Wealth Flow Trading, your go-to channel for making sense of Forex, mastering trading psychology, and building lasting wealth. If you've ever heard the word Forex and felt a little intimidated or confused, you're in the right place. By the end of this short video, you'll have a crystal clear understanding of what Forex is and how it works, even if you're starting from absolute zero. Ready to dive in? Let's get started. So, what exactly is Forex? The word itself is short for foreign exchange. Think of it as a massive, global marketplace where currencies from all over the world are traded. It's not a physical place like a stock exchange. It's a decentralized network that operates 24 hours a day, 5 days a week. Every time you travel to another country and exchange your money, you're participating in the Forex market on a small scale. In the trading world, however, we do this on a much larger scale to capitalize on the changing values of these currencies. When you look at a Forex chart, you'll always see currencies listed in pairs like USD, GBP, OJPY, or USD, JPY. The first currency in the pair is called the base currency, and the second is the quote currency. The price you see represents how much of the quote currency is needed to buy 1 unit of the base currency. The core idea is simple. You're betting that one currency will get stronger or weaker relative to the other. It's this constant fluctuation, this dance between currencies that creates opportunities for traders to profit. Now, how does a trade actually work? It boils down to two fundamental actions, buying and selling. When you buy a currency pair, also known as going long, you're speculating that the price will go up. For example, if you buy USD, you believe the euro will strengthen against the US dollar. On the other hand, when you sell a pair or go short, you're expecting the price to fall. In this case, you believe the euro is going to weaken against the dollar. An important thing to remember is that you're not physically buying stacks of euros or yen. You are trading what's called a contract for difference, or CFD, which means you're simply speculating on the price movement without ever owning the underlying asset. It's all about predicting the direction of the price. So, what makes these prices move up and down so much? A whole bunch of factors. Major economic news releases, like employment reports or GDP figures, can cause huge swings. Central bank decisions on interest rates are another massive driver. If a country raises its interest rates, its currency often becomes more attractive to investors, causing its value to rise. Inflation data, political stability, and even general market sentiment, what traders collectively think and feel about a currency, all play a significant role. It might sound like a lot to track, but you don't need to be an economics professor to succeed. Successful traders learn to focus on how the market reacts to this information and identify the resulting trends. This brings us to the most important question: how do traders actually make money? Profit and loss in Forex are measured in tiny increments called pips, which stands for percentage in point. A pip is typically the fourth decimal place in a currency pair's price. When the market moves in the direction you predicted, you accumulate pips. The more the price moves in your favor, the more pips you gain and the larger your profit. Of course, the reverse is also true. If the market moves against you, you lose pips. The size of your profit or loss is also determined by your position size, or how much money you've allocated to the trade. But here's the most crucial piece of advice I can give you. No strategy, no matter how good, will save you without proper risk management. This means never risking more money than you are willing to lose on a single trade, using tools like stop losses to automatically close a losing trade at a predetermined level, and having a clear plan before you ever click buy or sell. Risk management is the foundation upon which all successful trading careers are built. It's what separates professional traders from gamblers. And there you have it. That's the world of Forex explained in the simplest way possible. It's a dynamic market where you trade currency pairs, profiting from price movements driven by global economic events. It's all about predicting direction and, most importantly, managing your risk. If you found this breakdown helpful and want to continue learning with us, make sure to hit that like button and subscribe to Wealth Flow Trading for more beginner-friendly lessons. We're here to help you grow smarter, not harder. Thanks for watching, and I'll see you in the next video.